Every year, the tax deadline looms, a universal experience that often brings a knot of anxiety. We meticulously gather our W-2s, receipts, and various forms, hoping we haven't missed anything. For many of us, it feels like a significant portion of our hard-earned money simply vanishes into the government's coffers. We dutifully pay our income tax, property tax, sales tax, and more. And with each payment, a quiet frustration often bubbles up, the feeling that the system is stacked against us, especially when we hear whispers that the ultra-wealthy seem to operate by a different set of rules. We've all heard the stories, perhaps read the headlines: billionaires paying a lower effective tax rate than their secretaries, massive corporations seemingly sidestepping their obligations. It fuels a sense of injustice, making us wonder if the system is truly fair. Is it possible that the wealthiest individuals, with all their resources, truly manage to pay less tax, legally, than the average working person? And if so, what kind of elaborate maneuvers are they employing to achieve this? This isn't about tax evasion, which is illegal. This is about legal tax avoidance, which is often seen as smart financial planning for the ultra-rich. This video isn't just about how the wealthy legally pay less tax, it's about exploring a deeper question: is it actually worth it for them? Beyond the headlines and the perceived advantages, what are the true costs, complexities, and trade-offs involved in playing this high-stakes financial game? Does the pursuit of lower taxes bring hidden burdens, personal sacrifices, or unforeseen challenges? We'll strip away the jargon and emotional rhetoric to understand the motivations, mechanisms, and the ultimate calculus behind these sophisticated strategies. To understand how the wealthy navigate taxes, we first need to grasp a fundamental distinction: the difference between income and wealth. For most of us, our primary source of money is our income, the salary we earn from our jobs. This income is taxed regularly, directly from our paychecks. But for the ultra-wealthy, their money often isn't primarily income in the traditional sense. It's wealth, assets like stocks, real estate, businesses, and other investments that appreciate in value over time. This distinction is key. Think of it like this: most of us have one main income bucket that gets taxed heavily as we fill it. The wealthy, however, have many wealth buckets. These buckets aren't necessarily filled with cash that gets taxed annually. Instead, the value of the buckets themselves grows. When they need cash, they might take a loan against one of these growing buckets, or sell a small portion, which is taxed differently than regular income. This fundamental difference is crucial to understanding their tax strategies. One common misunderstanding is the idea that the wealthy simply don't pay income tax. This isn't entirely true. If a wealthy individual earns a salary, they pay income tax just like anyone else. The crucial point is that their taxable income might be a small fraction of their overall wealth. They might take a very small salary from their company or even no salary at all, instead preferring to hold assets that grow in value, which are taxed differently, or not at all until sold. This dramatically lowers their apparent income tax bill. This brings us to a cornerstone of wealthy tax strategy: capital gains. When you sell an asset, like a stock, a piece of real estate, or a business, for more than you bought it, the profit is called a capital gain. This profit is taxed, but often at a lower rate than ordinary income, especially if you held the asset for more than a year. This lower rate incentivizes investment, but it also creates a significant advantage for those whose primary source of wealth growth is through investments rather than wages. One powerful strategy for the wealthy is deferral. This means postponing when you pay taxes. For example, if you hold onto a stock for many years and its value grows significantly, you don't pay capital gains tax until you actually sell that stock. This allows your wealth to compound tax-free for decades. For an average person, their salary is taxed immediately. For the wealthy, they can often decide when to trigger a taxable event, giving them immense control over their tax bill, and allowing their money to grow significantly longer. Here's a surprising truth: Wealthy individuals often avoid selling their appreciating assets, even when they need cash. Instead, they borrow money using their assets as collateral. A loan is not considered income, so it's not taxed. This allows them to access liquidity without triggering capital gains taxes, while their underlying assets continue to grow and defer taxes. It's like having a valuable painting. You don't sell it for cash, you get a loan against it and keep the painting, allowing its value to climb. Another legal strategy involves maximizing deductions. For business owners, many expenses related to their enterprise are deductible from their taxable income. This isn't a secret loophole, it's a fundamental part of tax law designed to encourage business activity. However, for the wealthy who own multiple businesses, or whose lifestyle can be intertwined with their business interests, the line between personal and business expenses can become quite nuanced, leading to significant tax reductions. Trusts are sophisticated legal arrangements where assets are held by one party, the trustee, for the benefit of another, the beneficiary. For the wealthy, trusts are powerful tools for estate planning, asset protection, and tax optimization, especially across generations. They can help reduce estate taxes, which are taxes on inherited wealth, and ensure that assets are distributed according to specific wishes, sometimes many years into the future, all while deferring or minimizing tax liabilities. This secures legacies. Wealthy individuals often establish private charitable foundations. Not only does this allow them to support causes they care about, but it also provides significant tax benefits. Contributions to these foundations are typically tax-deductible, reducing their taxable income. The assets within the foundation then grow tax-free, and while they must eventually be distributed to charities, the donor retains considerable control over how and when those funds are dispersed, often for decades, allowing for strategic giving. Let's look at real estate. While properties often appreciate in value, which leads to capital gains when sold, tax laws also allow owners to deduct a portion of the property's value each year as depreciation. This is an accounting concept that assumes assets wear out over time. Even if the property is actually increasing in market value, depreciation creates a paper loss that reduces taxable income, sometimes even to zero, allowing the owner to defer significant taxes. It's a powerful tool for property owners. Imagine a business has a bad year and loses money. These net operating losses can often be carried forward to offset future profits. For the wealthy, who might own many businesses or make large, sometimes risky investments, these losses can become powerful tax tools. A significant loss in one venture can offset gains in another, or even past profits, potentially leading to tax refunds or drastically reduced future tax bills. This strategy effectively smooths out the tax impact of fluctuating business performance. For the truly ultra-wealthy with global assets and businesses, the tax strategies become even more intricate. They can strategically locate entities in jurisdictions with more favorable tax laws, or use international agreements to minimize their overall tax burden. This isn't about hiding money illegally, it's about navigating the complex web of international tax treaties and regulations to optimize where and how profits are reported and taxed. This is a level of complexity far beyond the average individual's financial situation, requiring global expertise. Now that we've touched on some of the mechanisms, let's turn to our central question: is it actually worth it? The first, and perhaps most obvious, hidden cost is complexity itself. These aren't simple adjustments. Each strategy we've discussed involves layers of legal structures, specific rules, and ongoing management. It's like building a custom-designed skyscraper when all you need is a house, incredibly powerful, but also incredibly intricate and prone to needing constant attention. This complexity is a significant burden. To navigate this labyrinth of tax law, the wealthy don't do it alone. They hire an entire tax army, teams of high-priced tax lawyers, specialized accountants, estate planners, and financial advisors. These experts charge significant fees, often in the hundreds of thousands, if not millions, of dollars annually. For an average person, paying a few $100s for tax software or an accountant once a year is standard. For the wealthy, it's a constant, substantial overhead cost just to stay compliant and optimized. Beyond the financial cost, there's a significant time investment and mental load. Even with an army of experts, the wealthy individual must still be actively involved in high-level decision-making. They need to understand the strategies, approve plans, and stay informed of changes in tax law. This isn't passive, it requires continuous engagement, endless meetings, and a constant allocation of mental energy that could otherwise be spent on their businesses, families, or leisure. Their time becomes a valuable, taxed commodity. Many tax-efficient strategies involve tying up assets for long periods. Deferring capital gains means not selling the asset. Establishing a trust means you no longer directly control those funds. While these strategies minimize current taxes, they also significantly reduce immediate liquidity, the ability to easily convert assets into cash. This can sometimes create situations where a wealthy individual, despite vast assets, might feel cash poor or struggle to access funds quickly without triggering a large tax bill. It's a common, if counterintuitive, dilemma. In today's interconnected world, how wealth is managed and taxed is under constant public scrutiny. Headlines about minimal tax payments by billionaires can ignite public outrage, leading to reputational damage. While these strategies are legal, they often clash with public perceptions of fairness. This can translate into boycotts, political pressure, and a negative public image, which for some, like entrepreneurs or public figures, can be a significant, unquantifiable cost that damages their brand or legacy. The court of public opinion can be harsh. Tax laws are not static, they change constantly. What is a perfectly legitimate strategy today might be limited or eliminated tomorrow by new legislation. This means that long-term tax plans carry an inherent risk of being undermined by policy shifts. The wealthy must constantly adapt, re-strategize, and spend even more on expert advice to navigate these changes, making their tax planning a perpetual, uncertain endeavor. It's a game with constantly shifting rules, adding to the inherent stress. It's important to recognize that for the wealthy, the goal isn't just to pay less tax for the sake of it. These strategies are often deeply intertwined with broader financial objectives, growing their businesses, creating generational wealth, funding philanthropic endeavors, or simply retaining control over their assets. Tax optimization is a tool to achieve these larger goals, not usually an end in itself. Understanding this motivation helps contextualize why they go to such lengths, accepting the complexities involved. When we hear the wealthy pay less tax, it's easy to imagine they're just keeping more cash in their pockets. But often, the money saved isn't immediately available for personal spending. It's frequently reinvested into their businesses, held in trusts, or dedicated to foundations. These funds continue to work for them, but they aren't necessarily liquid cash for luxury purchases. It's about growing total net worth and securing future assets, not just reducing an immediate tax bill for frivolous spending. Consider an entrepreneur who builds a successful company. They could take a large salary, paying significant income tax. Or, they could reinvest profits back into the business, delaying personal income, growing the company's value, and eventually realizing capital gains when they sell or go public. The latter often results in lower overall tax, but it means sacrificing immediate personal income for long-term growth and bigger future payouts. This is a common trade-off for business builders, prioritizing long-term vision over immediate gratification. Even for smaller business owners, these principles apply, albeit on a smaller scale. They also leverage deductions for business expenses, invest profits back into their companies, and aim to grow their asset base. While they might not have a tax army, they rely on knowledgeable accountants to optimize their finances. The motivation is similar: to retain capital for growth and secure their financial future, not just to avoid taxes for personal gain. This demonstrates the scalability of these financial principles. For the truly wealthy, the worth it calculation often extends far beyond their own lifetime. Estate planning, through trusts and other mechanisms, is designed to ensure their wealth endures for future generations, minimizing estate and inheritance taxes. This involves sacrificing personal control over assets in the present for the long-term benefit of their lineage. It's a strategic decision to build a legacy, not just hoard money for themselves, requiring foresight and complex arrangements. Compliance with complex tax laws isn't just about paying experts, it's an opportunity cost. The mental energy, the research, the constant monitoring of regulations, and the strategic planning involved could otherwise be directed towards new business ventures, innovative projects, or philanthropic initiatives that have a broader impact. The focus on tax optimization, while financially beneficial, can divert significant resources that might otherwise generate even greater value elsewhere, a hidden cost that's rarely discussed. While entirely legal, the sophisticated tax strategies employed by the wealthy often raise ethical questions. Does it undermine social cohesion? Is it fair? Some wealthy individuals grapple with these moral burdens, leading them to actively advocate for higher taxes on the rich or to engage in significant philanthropy. For others, the legal framework is simply the rulebook they play by. This personal dimension of worth it is highly individual and often unseen, adding another layer to the complex equation. A common misunderstanding is that these tax strategies are exclusive to billionaires. In reality, many of the underlying principles are accessible to anyone who owns assets or runs a business. Capital gains, deductions, and even some trust structures are available to middle-class investors and small business owners. The difference is the scale, complexity, and the level of expert resources required to maximize their benefits. It's less about a secret club and more about the scale of play, making them universally relevant. Another surprising truth is that tax optimization for the wealthy is an active, ongoing process, not a passive setup. It requires continuous monitoring, adjustments, and strategic decisions in response to market changes, new investments, and evolving tax laws. It's not a set-it-and-forget-it system. This constant vigilance adds to the mental and financial burden, reinforcing that these tax advantages come at a price of perpetual engagement. The game never truly ends. When taxes are deferred, the money that would have been paid to the government continues to grow, often for years or decades. This is the power of compounding. A small percentage saved annually on a large sum, reinvested over decades, can lead to exponential growth. This tax efficiency is a core driver of wealth accumulation, allowing assets to expand significantly more than if they were subject to annual taxation. This long-term view is critical to understanding the true worth of these strategies. Many of these tax strategies aren't loopholes in the common negative sense, but rather intentional incentives built into the tax code. Governments often design tax laws to encourage certain behaviors: investment in businesses, charitable giving, real estate development, or long-term capital formation. The wealthy simply have the resources to maximize their utilization of these incentives, often on a scale unimaginable to the average individual. They are playing by rules designed to foster economic activity. Let's compare two scenarios. Scenario A: you buy a stock, sell it in 6 months for a profit. This short-term capital gain is taxed at your ordinary income rate, which can be high. Scenario B: you buy a stock, hold it for 5 years, then sell it for a profit. This long-term capital gain is taxed at a significantly lower rate. The wealthy almost exclusively play the long game, demonstrating the power of patience and strategic holding periods for maximizing after-tax returns. This is a fundamental difference in approach. While aiming for lower taxes, the wealthy and their advisors also carry a heavy burden of compliance and regulation. Failing to correctly implement these complex strategies can lead to severe penalties, audits, and legal battles with tax authorities. The margin for error is slim, and the stakes are incredibly high. This isn't a game for the faint of heart or those unwilling to invest heavily in meticulous execution and constant review. The risk of misstep is a constant pressure. The concept of fairness in taxation is subjective and often debated. Is it fair that those with capital pay less tax than those with income? Proponents argue it incentivizes investment and job creation. Critics argue it perpetuates inequality. Regardless of your stance, understanding the mechanisms reveals that the wealthy are generally playing by the rules as written, leveraging incentives designed to promote certain economic behaviors. The debate then shifts from individual behavior to policy design, a critical distinction. So, is how the wealthy legally pay less tax actually worth it? For those with vast assets and complex financial structures, the answer is often a resounding yes, but with significant caveats. The financial benefits of deferral, lower capital gains, and strategic deductions are immense and compound over time, leading to exponential wealth growth. However, these gains come at the cost of significant time, money for expert fees, reduced liquidity, constant vigilance, and potential public scrutiny. It's a complex equation. Ultimately, the wealthy play a fundamentally different financial game than most of us. Their focus is on preserving and growing capital, leveraging assets, and planning across generations, rather than simply maximizing immediate income. The tax system, with its various incentives and differentiations between income and capital, is a major rulebook in this game. To participate effectively requires immense resources and a willingness to engage in highly complex and often long-term strategies. It's not just a bigger game, it's a different one. The perception that the wealthy effortlessly bypass taxes often overlooks the very real trade-offs they make. Their strategies are not magic, they are calculated, resource-intensive decisions that reshape their financial lives, often at the expense of simplicity, immediate access to funds, or even public goodwill. Every tax saving often comes with a condition, a restriction, or a demand on their time and attention. These trade-offs are central to understanding the true cost of their tax efficiency and the commitment required. It's also worth noting that not every wealthy person chooses to engage in the most aggressive tax optimization. Some prefer simplicity, prioritizing immediate liquidity or less public scrutiny. Others may feel a moral obligation to pay higher taxes. The decision to pursue extensive tax planning is itself a calculated choice, reflecting individual priorities, risk tolerance, and values. There isn't a single, monolithic wealthy strategy, it's a spectrum of choices based on individual philosophies and objectives. Ultimately, our exploration reveals less about individual morality and more about the design of our tax system. It's a system that incentivizes capital growth and long-term investment, and those with the most capital are best positioned to leverage those incentives. The perceived unfairness often stems from the different tax treatments of income versus wealth, a policy choice with deep historical roots and ongoing economic implications for everyone in society. It's a reflection of societal values embedded in legislation. The debate around how the wealthy are taxed will undoubtedly continue. It's a crucial dialogue for societies worldwide, balancing the need for public revenue with economic incentives and individual rights. Our goal here was not to advocate for any particular policy, but to demystify the complex financial landscape, showing that the seemingly simple question of "is it worth it?" opens up a world of sophisticated strategies and very real trade-offs for those who employ them. It's a conversation worth having with a clearer understanding. So, what are our key takeaways? First, the wealthy utilize legal, complex strategies to defer and reduce taxes on their wealth, not primarily their income. Second, this comes with substantial costs, high expert fees, immense time investment, reduced liquidity, and reputational risks. Third, it's often driven by goals beyond just saving tax, like generational wealth and business growth. And finally, these strategies are a different financial game altogether, leveraging a tax system designed to incentivize certain behaviors. A lot to unpack. Understanding these nuances is vital. It shifts the conversation from anger at perceived unfairness to a more informed discussion about policy, incentives, and the true cost-benefit analysis for those at the pinnacle of the financial world. The question, is it actually worth it, doesn't have a simple yes or no answer. It's a complex equation with many variables, revealing that even for the wealthiest, there are significant prices to pay for their tax efficiency. A truly comprehensive perspective requires looking at all sides of the coin,